Okay, so in chapter 16.1, we're going to take a look at some different ways that the federal government taxes, why they tax, how they tax, what types of taxes, some non-tax sources of federal revenue, uh, what limits the Congress has on taxing, what they're allowed to do, some technical details, some of which you may need to write down, some of which you won't. I'm going to switch back and forth on this screen between what you see here. Let me increase the view a little bit so you can see a little better what you see here. And also, I'm going to go to a PowerPoint that I'll label and say, okay, this is what you need to write for number X. So good fiscal policy, and I'm going to switch to a PowerPoint here, over here. Good fiscal policy, number one. So the fiscal policy, let's define it, and then it's asking why is it important. Fiscal policy is when the government uses spending and taxes to influence the economy. Okay, that's how fiscal policy is defined. In terms of that, let me zoom this in a little bit. So when the government uses spending and taxing to influence policy, how is that defined? That's how it's defined. Important fiscal policy affects the economy. It's important because the fiscal policy affects the economy. So Congress, Article 1, Section 8, Clause 1, gives the Congress the power to tax for reasons that are laid out, common defense, general welfare. Okay, so in real language, what does that mean? In real language, that basically means that Congress, two ways that Congress uses its power to tax. It uses a main source of money, of course, obviously, for the federal government. How would they get their money if they didn't? And then regulate or prevent an activity or force a change. Sin tax, taxes on, the Obamacare situation. If you don't, that's one of the reasons the Supreme Court made Obamacare legal, by the way, was that if you didn't have health insurance, you'd be forced to pay a tax. So they're trying to force you into an activity. Higher taxes on cigarettes, higher taxes on gasoline to try to force to less gas consumption. Those types of things for regulation. So again, the Constitution does limit the taxing power of Congress, though it's not absolute. There's some limits to it. So number 3, here are some limits. Number 3, and there are four major limits here. The taxes must be for public purposes, not for personal benefit. Duh, obviously. Exports, items going out of the country, goods going out of the country, that's what exports are, cannot be taxed. They must be evenly distributed among the states based on population. So the taxes have to be fair to all the states. And the federal tax rates must be set at the same for all the states. You can't have one tax rate in one state and another tax rate in another state. It doesn't work that way. So I'm kind of, incidentally, as you're getting these down on your 16.1 note sheet, it might help, if I'm going too fast for the video, you've got the stop button. So if I'm by switching back and forth between screens, remember you can stop it and say I need to stop at this point and get something down. That's fine too. Okay, so that's the 4 ways the Constitution limits the taxing power. So why is the income tax a progressive tax? Okay, we're going to look at 3 different types of taxes. But a progressive tax basically is a tax that's in proportion to a person's income. Income tax is a good example since the tax increases with the level of one's income. So number 4, why is the income tax a progressive tax? Because it's in proportion to a person's income. The more you make, the more you pay. The more you make, the more you pay. Okay, and you'll learn this throughout your life. So one of the neat things about, not neat, but one of the interesting things about this particular section, you'll be faced with it throughout your life. So like you're going to having a little basic understanding of the tax system. It could be helpful, so you understand at least where Uncle Sam is taking your money and how he's taking your money, basically. All right, so there's a limitation, an applied limitation. We talked about this. We could say at the beginning of the semester, bounce back in trimesters. But the federal government cannot tax the states or any of the local governments in excess of their proper government functions. So, like education, police, fire, road construction, local operations here cannot be taxed. In fact, actually, usually what happens is those types of activities are actually supported by grants or other grants through the federal government usually, or other allotment of monies. It's actually the opposite way around. They're not taxed; they're actually supported through the federal government and revenue. Okay, so every time I show some of these slides, they're going to be at the top. These definitions: progressive tax. The higher one's income, the higher the tax rate. Regressive: the higher one's income, the lower the tax rate as a percentage of your income. And then a proportional, there's different, current federal taxes are set up into these three buckets. The progressive, where the income tax is. Regressive, the higher one's income, the lower the tax rate. And then proportional, everyone pays an equal proportion of their income. So keep that in mind as we're moving along. So how does the government then tell how much income tax a person owes for the year? They have to file an income tax return to show their earnings. So answer number 5, they have to file an income tax return. This is what's due April 15th every year. Your parents scrambling around to do this. This is what you have to do, and this is how you're able to tell how much you've earned and show it and declare your income. So number 6, the question's asking, how do most people pay their income taxes? Okay, so how do they pay their income taxes? So this is writing this down either through taxes on your paycheck, withholdings, which is the largest source of federal revenue. Incidentally, this is a progressive tax. This is the higher your income, the higher your tax rate. Remember, individual income tax. So in 2015, for example, personal exemptions. So you could declare $4,000 for yourself and $4,000 for each independent that was not taxed, that you would get free and clear, that wasn't taxed. So exempted from your income, the first $4,000 that you make, or the first and then that's why some people overpay on their taxes based on the exemptions and deductions, because they've paid too much, and that's why at April 15th you end up getting a refund. So again, number 6, taxes in your paycheck are the largest source of federal revenue. Most people pay through withholdings. You could say, we could change this to withholdings here. Okay. Now, keeping this in mind, we've got individual. You've got a chart on yours. It looks like a chart: individual, corporate, and social. Corporate income and social insurance. It's asking you to describe them and so on. So let's take a look at that. Let's take a look at that and see how much time I have. I may have to stop this video and start on another video. So again, individual income tax. Taxable income. So taxes on individual income is a progressive type of tax. So for this one, for the individual income, you're writing this description down under individual income. These are, again, taxes on your paycheck. Taxable income is the largest source of federal revenue. So write down also for the definition of taxable income under number 7A. Again, this is 7A. 7A, all this is right here. This is all 7A. That the 2010 taxable income is income less the exemptions and deductions. So you're taking those out. So again, 2015 personal exemptions were $4,000 for each, plus $4,000 for each person, plus $4,000 for each dependent. So I've got to stop this now and go to recording number 2. So I will pick this up in a second recording, decently long section.